And in the earnings arena, improved efficiencies and margin expansion across its major divisions have bolstered Premier Group's half-year profit. The food producer also announced a share buyback program aimed at maintaining its financial structure ahead of its acquisition of RFG Holdings. Premier said the repurchase aligns with its disciplined capital allocation framework. And CEO Kobus Gertenbach joins us now with greater insight of that performance. Kobus, thanks so much for your time this afternoon. Maybe let's start off with the numbers. A bit of a disconnect when you look at growth between revenue and profit. While earnings are growing by double digits, top line growth has been more subdued. Is this mainly a reflection of dynamics playing out in soft commodity markets? And where are you seeing most pressure, in wheat or in maize?
Yes, it is very much soft commodity driven. Premier's portfolio of products is very much tied to particularly the wheat and the maize prices. And maize in particular had a big run up in raw maize prices last year on the back of drought in southern Africa, where particularly all our neighbors to the north also struggled to produce enough maize, and we're importing a lot of maize from South Africa. And so prices this time last year was in excess of 5,000 Rand a ton for raw maize. Where we're sitting at the moment is around about 3,800 Rand a ton, and a lot of that decline in the raw maize prices was passed on to the consumers, where we've seen the deflation or the reduction in prices of maize meal being over 30% passed on to the consumer. So, from that perspective, if you can also see from Shoprite's trading update that their basket of products was almost flat completely with zero inflation. And a lot of that was the bulk staple food categories being in negative or deflationary territory, and they're offsetting the inflation in the rest of their basket. So, I think against that backdrop, a 6% increase in revenue is actually testament to quite a strong operating performance.
And that was going to be my next question then, Kobus, how you're managing to balance affordable pricing with maintaining sustainable margins, especially given that your products are mainly staple products, your maize, your bread, etc., etc. And I guess this is where cost discipline comes in as well.
Yes, a combination of cost discipline and making the right capital investments so that you have state-of-the-art facilities that are able to or capable of operating at world-class efficiencies and at scale where you have very low cost of production. And I think we've, over many years, we have continued to make those investments in our facilities. And we've reaped the benefits of those investments. I think it's also, a machine is only that good. It's the extent to which we've also developed our people and our leadership capability all the way down to frontline workers that have all contributed their part to make sure that we run our operations as efficiently as possible and that we remain the lowest cost producer in the market. At the end of the day, in a lot of our categories, we don't really have the opportunity to just increase our prices ahead of our competition. But if we're able to keep our costs well below that of our competition, then we can sustain our margins and we can continue to drive profit growth.
And you speak about competition and how you have been trying to remain competitive in an environment where the consumer is cash strapped, right? We've also been seeing a bit of a move to private label products. Have you been seeing that in some of your categories?
Well, the bulk staple categories like maize and cake flour don't really lend themselves that heavily to private label. There's always been private label participants in the market, but it's very difficult because it's such low margin products already that it's very difficult to sell private label at a much lower cost than the branded products in store for the participants in the value chain to make money. On the bread side, we've seen the emergence of the bakery loaf by Shopritethat have come in the last 18 months or 2 years. And it's done reasonably well, but we find that, if we put a top quality product at a competitive price on the shelf, the consumer still elects to buy what tastes the best and what they prefer. And that has continued to sustain and support our business, even in the a competitive environment of private label products.
Let's get into some of your investments. The Ayrton Mega Bakery project appears to be on track. Can you just quantify how much the additional capacity it will bring once both phases are fully commissioned, and what impact you expect that to have in terms of volume growth and market share in the inland region?
So, I mean, the first and foremost investment into the Ayrton Bakery was on the basis that our bakery facilities in the southern Gauteng market was nearing the end of its useful life. These bakeries were over 30 years old and really needed upgrading anyway. And we just decided to rather consolidate them, build for scale and efficiency. And so a big part of the Ayrton project is not actually to build a significant amount of new capacity, but it's once again to lower the cost of our production and our operations to be the lowest cost producer in the market. The benefit that we get from that is that you have the latest state-of-the-art technology, which gives you a consistent quality product that is just superior to what any of our competitors are able to place on shelf. And that combined with the recipes that we've been working on for years and years, it gives us a product that the consumer showed us everywhere else in the country that they prefer if they have access to it. And I think that geographically, the southern Gauteng market is the biggest bread market in South Africa, and it's the last geographical area where we really needed to upgrade our efficiencies, but also upgrade to the top quality that we've provided in the rest of the country. And I think with the startup of Ayrton at the end of the month, it's a sizable investment for us. It's over 700 million rand project. It's taken us a full 2.5 years to construct the bakery. And with the first of its two production lines coming on stream the end of November, I think we are going to be able to put that quality product into the market during the festive season. December is usually the highest sales volume month in the baking industry because people have 13th checks, they have money that they've saved up from stockfels and everything else. And so there's just a little bit more disposable income available. And then people tend to consume more bread as a result of the availability of that extra money. So, we're really excited to finally see that project coming on stream.
And quickly before I let you go, the last time we spoke, you hinted at M&A activity. Months later, and you've made an offer for RFG. Just walk us through the rationale behind that and whether you expect that deal to be completed without any regulatory hurdles.
Yeah, I mean, Rhodes is a magnificent company. They've been around for the best part of 100 years plus as well. They've built up a very strong portfolio of very high quality products with brands that are well known and recognized for that quality. And nowhere in their product portfolio do they overlap with any of our products. The two businesses are actually completely complementary to each other in terms of the product baskets. And so, for us to be able to bring that portfolio and combine it with Premier's portfolio at a valuation level that we believed was a fair value for both the Rhodes shareholders and for the Premier's shareholders to acquire, really is quite an exciting opportunity for all the parties involved. And the two major hurdles that it still has to clear is one, the Rhodes shareholders still has to vote in favor of the transaction. And because it's such a big transaction for Rhodes, they need 75% of shareholders to vote in favor. Their circular will go out on this Thursday, the 13th of November, and their meeting will take place on Thursday, the 11th of December. We're very confident that the Rhodes shareholders will vote in favor of this transaction. And so then it's really just the regulatory hurdle of the competition approval. The competition commissioner has been hard at work. He has sent out a lot of communications, doing exactly what is expected of him in terms of a vigorous process in assessing the competitive nature of this transaction. And we're very confident that, there are no real competitive issues here. And that we will probably in the new year engage a little bit with the Commission and the Tribunal on any public interest concerns that they may have. Personally, I feel those are very limited as well, given that we're not a foreign company coming in to buy a local company, or where we could be at risk of shutting down local manufacturing and moving that offshore or anything like that. To the contrary, I mean, Premier's got a stellar track record of investing in the country, and we've certainly expect to continue to do that into the roads portfolio as well. So I'm highly confident that, with the quality of the regulatory individuals involved and the work that they're doing and the experience of the Commission in dealing with these size transactions, I think we should definitely be able to conclude it before the end of our financial year, 31 March. So I'm quite hopeful for that.
All right, let's leave it there, Kobus. Thanks so much for your time today. Now, that was Kobus Gertenbach, CEO of Premier Group.